Hi everyone and welcome to the Unique Creepy channel. Today we had a unique opportunity to communicate with a representative of the Sif Chain project. This platform is a decentralized exchange with great potential, where Cosmos meets Ethereum and many useful features for earning will be available in the near future. So I propose to move on to meet our guest and learn from him about all the benefits of Sif Chain. Hello Sif Moon, I'm glad that you agreed to meet with me and tell me about your project. Today I would like to ask you a few questions about SifChain, the advantages of this platform and the possibilities of trading on it. If you're ready to give me an interview, then I would like to quickly move on to the first question. First of all, could you briefly tell my subscribers what SifChain is and what is your role there?
Yeah, absolutely. So SifChain is a decentralized exchange, and it's built on the Cosmos SDK. What that means is that people can swap assets, any asset that they have for any other asset that they want. And because we're built with the Cosmos SDK, users can do that really quickly and really cheaply. And because we're built with the Cosmos SDK, we utilize the Cosmos IBC functionality, which means that we're connected to many of the other Cosmos blockchains, meaning that we can import their tokens into our DEX and then export their tokens from SifChain to their DEX as well. And then we're also connected to the Ethereum blockchain. So we are the first and only for quite some time in the Cosmos ecosystem to connect the Cosmos ecosystem to the Ethereum ecosystem, meaning that users could import their ERC20 assets into SifChain, swap them to any other ERC20 asset that they wanted or to a Cosmos native asset. And then they could also export any asset that they had on SifChain to the Ethereum network as well. And yeah, that's what we are, decentralized exchange built with the Cosmos SDK, connected to Ethereum right now. And connected to other Cosmos chains, soon to be connected to much more EVM chains with our launcher Peggy 2. And then we also have a new feature coming up that's going to bring in a whole new class of traders in margin trading.
Okay, we have come to know that margin trading is going to be available on SifChain. And so what can you tell us about the deployment of this type of trading on this platform?
Yeah, so as of right now on the DEX, users can only do spot trading or spot swaps, meaning like you have one token and you want to get another token, and then you can come in and swap and execute that swap accordingly. How that works is that we have liquidity pools and liquidity providers. So people can come in, they can provide their tokens into the liquidity pool, and that enables people to execute spot swaps against that liquidity pool. And when users execute those swaps, they pay the liquidity providers a small fee in doing so. Basically, it's like, kind of like, thank you for allowing me to make this trade, and here's a fee that's paid to you for making it possible. What margin trading does is it brings in a whole new class of traders and a whole new class of functionality. Margin trading is basically someone can come in and they can say that they want to execute a trade, and in executing that trade, they put up an amount of collateral that they feel comfortable putting up, and then they borrow the remaining amount from the liquidity pool. That then makes their total position or their total position size. That position size is then swapped to the other token in that liquidity pool, and it's basically held in that position. And if they do really well and the trade does really well, that position would go up in value. So when they close their position, they've actually made money off of their margin trade. Obviously, it can go either way, and with margin trading, users are able to amplify their rewards or their benefits, and making money off of their trades, or they can amplify their losses as well because they're taking a risk in doing so. So essentially, what margin trading does is it does bring in an entirely new class of trader, historically quite different than spot traders, historically quite larger than spot traders in terms of size and volume. And with our deployment of our solution, we're going to be bringing in that market into SifChain, which will bring in a lot of benefits to traders looking to open margin positions, a lot of benefits to liquidity providers, which we can get into a little bit later. But yeah, just kind of expands our product out a bit more with a whole new feature and functionality that doesn't currently exist on SifChain. And the way that we've structured doesn't really exist anywhere in the Cosmos ecosystem right now.
Great. Please tell me, how is margin trading being implemented and how will it work?
Yeah, so something a little different with our solution of margin trading is because our DEX uses liquidity pools and liquidity providers provide liquidity to those liquidity pools, when a margin trader wants to come in and open a position, they will be borrowing funds from the liquidity pool and therefore the liquidity providers of that pool. So let's say, for example, I was interested in longing ROWAN, which is our native token. I'm interested in longing ROWAN against USDC, which essentially means in English terms, like I'm betting that the price of ROWAN will go up faster than the price of USDC in the same amount of period of time. And that's kind of the bet that I'm making. So I can come in and I say, okay, I want to make that bet. And making that bet, I provide an amount of collateral and I borrow the remaining size of the position from the liquidity pool. And this is important because in borrowing from the liquidity pool, I will then pay interest back to the liquidity pool, meaning back to the liquidity providers as well. So in like, usual traditional finance markets, it's usually like the bank that's taking the amount, like the bank is saying, I'm lending you, some funds, and then you are doing something with those funds and you're paying me, the bank, back in interest. And in our margin trading solution, because we're a decentralized exchange with liquidity providers, the people taking out margin positions will be paying interest back to the liquidity providers themselves. This is really important and really great because it creates a self-sustaining system where liquidity providers want to come in to provide liquidity because they're being compensated to do so with swap fees and interest fees. And then margin traders want to come in and take out positions because there's more liquidity and they can amplify their returns. And it kind of creates this flywheel cycle where margin traders are happy, liquidity providers are happy, and it kind of like removes the need for any additional type of like inflationary rewards, which is kind of the goal for SifChain at the moment, and really like any DEX that's out there right now is getting to a point where you're making real revenue, you're getting rid of inflationary rewards, and you're making the system really self-sustainable. So like at a very high level and in a nutshell, traders come in, they borrow funds from the liquidity pool, and borrowing funds from the liquidity pool, they pay interest back to the liquidity providers, which makes the liquidity providers really happy. And if the trade does really well, and margin traders can close their position, and they've hopefully closed their position and have amplified their returns off of it, and everyone's kind of happy. Obviously, there's the other case where margin traders can default on their position or get liquidated, which again goes with the amplifying returns and risks in both ways. But yes, that's how the system works. The traders come in, they pay interest, liquidity providers earn that interest, and it creates a self-sustaining cycle where they each feed each other.
Okay, this sounds very good, but what benefits can I get from margin trading as a liquidity provider?
Yeah, so this is kind of like the main, the biggest point here is, as a liquidity provider, so let's say if you come into our exchange and you are you're providing liquidity in the ROWAN ETH pool, for example. When margin traders come in and they can take out positions against the ROWAN ETH pool. So in this case, they can take out a position by longing ROWAN against ETH, or they can take a position out by longing ETH against ROWAN. And in doing that, they will again borrow funds from the liquidity pool and from you as the liquidity provider. Depending on which way they take their trade, so if they long ROWAN or if they long ETH, they will pay interest back to you in the token that they're taking their position out on. So that means you as a liquidity provider will be earning interest in both ROWAN and in both ETH, depending on which way traders are taking out their positions, which is really cool, right? So like that means like you in the ETH ROWAN pool, and I'll use a percentage just for example. But let's say that if it comes down that the APR percentages of what you're earning in interest, let's say if it's 90% to 100%, that APR that you're earning in 90 to 100% will be paid to you in a combination of ROWAN and an ETH, which is really unheard of anywhere else. And again, you can take that and you can look at the other pools as well. So you can say, like, if I provide liquidity in the ROWAN WBTC pool, you're earning that APR in ROWAN and WBTC. And then again, if you're doing it in the ROWAN Atom pool, you're earning that APR in ROWAN and Atom, and then again in ROWAN USDC, you're earning that interest in ROWAN and USDC. So when you look at percentages of, let's say, 100% APR that you're earning from interest, you getting that in our token is obviously very cool. But also you getting that in the other token as well. So like in USDC, in ETH, in WBTC, that's like very unheard of in this industry. And it's all from non-inflationary, right? So like at the end of the day, it makes it really, really, really attractive for a liquidity provider to come and provide liquidity when you're earning that type of yield and that type of returns from tokens that you love, right? So if like you're like really bullish on ETH, you can earn these really crazy and insane APRs in ETH. And it's not like we're minting this ETH. It's not like we're borrowing this ETH from somewhere. Like people taking out their margin positions are paying you interest in ETH to be able to take out their positions. So as a liquidity provider, what, to summarize it, what you can expect is that you can get some really lucrative returns in a variety of tokens, ROWAN being one of them, which is our native token. But whatever other pool you pull in, you will earn interest in that other token as well, which is really awesome, right? So like, let's say like hypothetically speaking, you even get 20% of APR earned in ETH. I don't think that's offered anywhere in the industry. Which is, kind of crazy. And then let alone you amplify that up like 50% or 80% or 100%. And it's just like a no brainer. Like, you're not going to get those returns anywhere else. So if you have ETH and you're really bullish on it, you might as well put it in our liquidity pool and make a really, really, really attractive yield in doing so.
Okay, that's good, but how does margin trading at SifChain generate real revenue through non-inflationary income?
Yeah, so up to this point, and kind of like every DEX faces this, right, is you need to attract a any DEX that runs off of liquidity providers and liquidity pools faces this situation, that you need to attract liquidity providers to come in and provide liquidity into your liquidity pools to enable swappers to be able to swap, right? And it kind of creates this like chicken and egg situation where it's like, liquidity providers only want to provide liquidity when they're earning something, but they can't earn anything until swapping happens, but swappers can't swap unless there's liquidity, right? So it's like, you kind of need to get the ball rolling. And it's like, okay, how do you really get that snowball rolling in a way that's is beneficial to both parties? Historically, what a lot of DEXs have done, SifChain included, is that you provide some sort of like inflationary rewards, right? So like, let's say if you like come in, provide liquidity to our ETH ROWAN pool, and we will like guarantee to give you, 150% APR. And then you might ask, well, where is that APR coming from, right? Like how am I getting 150% APR? And the truth is that it's usually, 99% of the time coming from inflationary rewards, meaning like the project is like, minting new tokens to give you rewards in hopes that like, you keep it, you don't immediately sell it. And that like it's enough to keep you in the liquidity pool. That obviously isn't very sustainable, right? So it's like, and if you want to call like DeFi 1.0, or even like, hinging towards DeFi 2.0, is okay, like how do we actually become sustainable as exchanges? Like we can't just mint new tokens all the time. And also it creates this like really rapid race to the bottom. And we already see it in the Cosmos ecosystem as well. It's like a new DEX pops up, they guarantee, some crazy percentage APR, like 1,000%, and then people move their liquidity from your DEX to their DEX because they're giving more APR, and then like they don't want to provide any inflationary rewards anymore, so they tamper them down, and then another DEX comes up and provides these crazy APRs, and so it's like it creates this race to the bottom, like who can provide the most lucrative APR by printing the most tokens, which clearly isn't good for anybody. It isn't good for any project or any DEX, and it really doesn't create healthy competition. So like alternative to that is okay, like how do you create more sustainable revenue? How do you create it in a way where you're not just minting tokens and giving away free tokens? A hot thing in the Cosmos ecosystem is like providing things like airdrops, or working with other projects to like have them come in and provide their token as rewards. So let's say like hypothetically, if we were to launch, a ROWAN and insert any of your favorite tokens as the other pair, we could like technically work with that project and say, hey, will you give us like 100,000 of your token that we can give away as rewards for the first people that come into the pool to hopefully, like get the cycle going. That is okay, but again, it's not very sustainable. Airdrops is okay, but it's not very sustainable. So like DEXs and I mean, specifically DEXs, are really forced to think really creatively, like, how do I actually make this sustainable? How do I keep people in our liquidity pools in a world where liquidity providers, like, historically aren't really faithful, right? Like, the switching cost is very little. They can switch from one DEX to another very easily, especially with an interoperable world. So like, how do you keep liquidity providers in your DEX when the switching costs are really easy, in a way where you're not just, like printing money and giving it away? The way that we're handling it is through margin trading. So we're introducing a new class of traders. We're having the traders fund the pools by paying interest back to them. And we're having the traders fund the pools in either side that they're taking out positions on. So in either ROWAN or in the other token, which is what I was just talking about. So we kind of like remove ourselves, like ourselves being SifChain, from the equation. We basically just like, hey, here's all these liquidity pools over here. Hey, margin traders, you can come over and borrow from these liquidity pools. And margin traders say, yes, I want to borrow, and I'm willing to pay you liquidity providers interest in doing so. And then, liquidity providers get that revenue. And then margin traders can close their position when they want, and both parties are kind of happy. And it removes SifChain or SifCore from the equation of having to like print and give out new rewards. So this is really unique, and not a lot of DEXs do this. And I think I really want to harp on that point, because some people think they see these APR percentages, they see 100%, 200%, sometimes even crazy like 1,000%, and they kind of get blinded by it. Like, a question to ask, and I encourage everyone to ask, is like, where is that percentage coming from? And that makes a huge difference. Is that percentage coming from inflationary tokens? Are you printing new tokens to give me that percentage? Or is that non-inflationary, aka real revenue? And that is a huge difference, because if you can get even like 50% of, or even like 25% of non-inflationary income paid to you, compared to 500% inflationary, like, you should take the lower non-inflationary revenue like in a heartbeat. So that's the word that we're trying to move to with margin trading, and we're right on the cusp of it. We're in the final stages of being able to deploy margin trading to our users. But yeah, that's how we're creating real revenue through non-inflationary income, is that we're having our margin traders pay interest to our liquidity providers, and then they kind of like self-sustain the system themselves without SifChain needing to step in and mint tokens and to give additional ROWAN to these users.
Great. SifMoon, are there any restrictions for potential margin trading to use SifChain DX liquidity pools to fund their margin trading positions?
And I'll answer, because we're rolling margin trading out in phases. So like, margin trading itself is like a whole roadmap with it. And in the first phase of margin trading, we're only enabling it on I think 5 pools. The ROWAN ETH, ROWAN USDC, ROWAN Frax, ROWAN WBTC. So I think 4 pools is what we're enabling it on. So obviously, if you want to take out a position on any other pool, that won't be allowed for the first iteration. And the reason we're doing it is because we just want to be, like, in any software development and deployment, like, we want to be really careful with our rollout. We want to make sure it looks good and it's working well. And also just to kind of like generate excitement, right? Like, we get the first pools enabled, people can take out positions on it. They can see how much interest that those pools are actually making. Other pools get really excited, or other people in other pools get really excited. They want their pool to be incorporated into it. And then, we kind of like slowly roll out more and more pools to being margin trading enabled. So that's restriction 1, is that we're intentionally restricting the pools right off the gate of which ones you can take margin positions out on. Restriction number 2 is our initial rollout is only being able to take positions out against ROWAN. So let's say if you want to long ROWAN against USDC, you can do so. If you want to long USDC against ROWAN, which is essentially shorting ROWAN in a roundabout way, you can do so. But our first iteration is taking out positions only against ROWAN. Come a subsequent iteration, which is going to be really exciting and really powerful, is when users can take out positions of a token against any other token on the DEX. And what I mean by that is that you can come in and you can say, I want to long Atom against USDC, or I want to long WBTC against Juno. And you can kind of remove ROWAN from the situation altogether, and you can long any token against any other token on the DEX. So that's going to come in a future iteration, not out the get-go. And then also in a future iteration is going to come true shorting. So being able to like truly short a token, which you cannot do out the get-go up front. The other restriction that I'll comment on is I do encourage margin traders to check their kind of like local jurisdiction, and if engaging in margin trading activity is legally allowed in the location that you reside in. Obviously, we have no control over that. That's like legislation on a national level. So I encourage those traders to follow those, to look up what their jurisdiction is and to make their decisions accordingly based on that. But yes, the product itself and the functionality itself, it's going to be a slow rolled out. So even if you can't do things right off the get-go, it's probably coming in future iterations. And in the first iteration, being able to long ROWAN against WBTC, Frax, USDC, and ETH, and then being able to long any of those tokens against ROWAN is what you can do, at least in the first iteration.
I understood you. And what fees do traders pay?
Yeah, good question. So this one is hard to answer for sure because it's all dynamic. So when margin traders come in and they take out a position against a pool, like I mentioned a couple of times now, they'll be paying interest in doing so, right? So that interest is very dynamic. It's not like a set fee, and what it's based off of is the health of the position, the health of the pool. A lot of math essentially goes into like calculating an interest at any given time. The minimum interest that is going to be charged is something, and let me make sure I have these zeros right, but 0.000002% each block is the interest that they're going to be paying. Block is about 8 seconds in Cosmos. So for your margin traders out there, I'll kind of let you do the math on it. But that's kind of like the minimum. That's like if you're in a very healthy pool, and your position is healthy, that's what you can expect to pay as a minimum. Obviously, as the pool gets more unhealthy, like let's say if there's a lot of margin positions being taken out on it, or the prices of the assets are acting in a certain way that's making the pool, like quote unquote more unhealthy, the interest rate is reflected accordingly. And the reason for that is to kind of keep the system in balance, right? So like the more unhealthy the pool gets, the more that like, you need to pay interest in order to keep your position out. Same way with really like any banking system in the world, right? It's like the more risky that the borrow is, or the collateral is, like you need to charge, more interest because it just keeps everything in sync and everything healthy. So it's very much like a teeter-totter, if you will, where if like things, are really healthy, the interest stays at the minimum rate. But as things start to get a little bit more unhealthy, margin traders will have to expect to pay more interest to keeping their positions open. And like that, and then as they pay more interest, or the pool gets back into being more healthy, then it'll go back to the minimum interest that they need to pay. But yeah, that's a lot of math that goes into it. We recommend that as a margin trader, when you open a position, just like any margin trading out there, but when you open your position, to keep an eye on it. We have charting integrated into the DEX now. Excuse me, I have a frog stuck in my throat. We have charting integrated into the DEX now, so you can watch real-time charts of the prices of the tokens that you've taken a position out on. And then you can see like really close to real time how your position is acting, what the interest rate is, how much interest you're paying, what your P&L is, and you can close your position at any time to make sure like you don't get liquidated.
Does margin trading change the process of exchanging spot of SifChain DX and staking or delegating ROWAN to the validator?
Staking and delegating ROWAN, no, absolutely not. That stays completely untouched. So staking and delegating, if you're a staker or you run a node, or you stake to a node or you delegate, you probably won't notice any difference. Besides, hopefully, you won't really notice any difference. Your rewards remain untouched. The margin traders aren't really borrowing from you at all. You're more securing the system. With that being said, it is a hope of ours in the very near future to take a percentage of interest that's made from margin positions take that and actually move it over to stakers and delegators to keep the system in balance. And the reason that I want to touch on this is because this has been a vision for SifChains for a while, is to move towards this thing called system income. So historically, in DEXs, like DEXs have split up the income that goes to liquidity providers and the income that goes to stakers and delegators. And it's kind of a challenge to like keep them in sync, of like making sure that it isn't too attractive to do one of those actions over the other, because you really need those two things to work harmoniously together. You really need people staking and delegating, and you really need people providing liquidity. So if you get too like heavily lopsided, where like it just makes more sense from a returns perspective to do one of those things over the other, then like you kind of get into this dangerous position where it's like, oh crap, like, you know, a lot of people seem to be providing liquidity instead of staking. Like, what are we gonna do about this? Our solution for that is what we call system income, where essentially like all income or revenue sources go into this like one bucket. This one bucket's called system income, and it's like literally split like either 50-50 or, you know, 52-48, whatever the percentage comes out being, between liquidity providers and stakers and delegators. And that way it keeps it really in balance, right? Like it doesn't really matter if you're staking or delegating or if you're providing liquidity at the end of the day. And it kind of like encourages you to do both. We're not there yet. That takes a bit of time to get to. So in the beginning of margin trading, you as a staker or delegator will not notice any differences at all. If you're spot swapping, you really shouldn't notice any difference. The only time that you'll notice a difference is if you try to execute a swap. I'll walk through the situation. If you try to execute a swap that's a very, very, very large swap, and let's say that the liquidity pool doesn't have that amount of liquidity on hand because there's a margin trading positions open and essentially it's borrowed out, you may get blocked in that situation where it's like, hey, we actually can't execute that swap for you because there's margin positions open and, you know, you're executing the swap so large that you're creeping into the position where there isn't enough liquidity to give you. That should be corrected very quickly by what I was just referring to of like the interest payments and bringing the system in whole. So like in those cases, right, how you fix that is that you encourage certain behavior to happen. You either encourage margin traders to close their positions, and you do that because the interest rate is going to be really high and they're like, whoa, I don't want to pay any more of this interest, so I'm going to close my position. Basically releasing that liquidity back to the liquidity pool so people can swap against it. Or, you know, they can say, I'm okay with paying that high interest. Like, I think that this position is going to do amazing and I'm okay paying that high interest. And when they start to pay that high interest, other liquidity providers will see how much money how much returns that liquidity pool is making, and will come in and provide more liquidity, which then again makes more liquidity available for spot swappers to execute on. So that's kind of like before how I was referring to interest rates keeping the system in balance. The interest rate can go up or down depending on how the pool is, and to keep the system in balance. So in the case where, like, let's say liquidity is usable liquidity is on the lower side, and spot swappers are seeing like, hey, we can execute swaps, interest rates gets jacked up. Users either say, I'm cool with paying that interest rate, which will then bring in more liquidity, or they'll say, I'm actually not cool paying this interest rate, I'll close my position, then, you know, releasing liquidity back to the pool so spot swappers can execute on them. This shouldn't happen, like if you're a spot swapper and you get blocked from making a swap, it should be corrected very quickly. And you know, and the system should hopefully like encourage behavior to correct it really easily. But outside of that, you as a spot swapper will notice no difference with margin trading being enabled. And on that, margin trading is actually its own, like, kind of like separate part of the DEX as well. So if like you're in the Sif Chain DEX, if you're spot swapping, the entire user experience will remain the exact same. It's not like you're like, wait, am I doing a margin position? This is confusing, I don't know. The spot swap is a completely different user experience in margin trading. When you click on margin trading, it'll open up an entirely new tab. You're basically in like kind of like a whole new product where you are opening and closing margin positions. And we did that intentionally so spot swappers don't get confused, and it's, you know, it's a really easy to say I'm in spot swapping or I'm in margin trading, and we keep those lines very distinct so users don't get confused.
That's really good, Sif Moon. This was my last question, and I would like to thank you for this interview. You provided a lot of information about Sif Chain, which in my opinion will allow my viewers to get acquainted with your project in detail and make the right investment decision. So with this, I would like to conclude our meeting and wish your project further development and prosperity.
Thank you so much. Yeah, I appreciate it.
Thank you.
Yeah, looking forward to working more together.
Thank you, Sif Moon. Goodbye.
Bye.